If you're a seven-figure business owner and you're struggling with cash flow at the moment, I want to give you some hot tips that will help you survive in 2025 and beyond, because there is a myth that once you get to seven figures, that you become some invincible beast. Now, there is something miraculous that is supposed to happen when you cross over that $1 million mark. And the unfortunate reality is we're seeing more 7 and 8 figure business owners reach out to us in financial hardship or on the cusp of finding themselves into some financial hot water. So I'm going to give you a little bit of a crash course on this that'll hopefully guide you through these turbulent times. Ensure you don't rack up a whole ton of debt, particularly with the ATO, and ensure that you can run a profitable and sustainable business. So what we need to understand, guys, is that symptoms such as tax debt, payment plans with the ATO, falling behind with your suppliers, and struggling with cash flow is largely a symptom that your financial model is no longer suitable at your current level of scale. What we often see is that businesses that have grown through the 6 figures mark, that have got to 7 figures, and in some cases 8 figures, have eroded the vast majority of their profit margins. And it's at this point they start having difficulties around cash flow. They're struggling to pay suppliers. They're struggling to meet their BAS and their IAS deadlines. They're going on payment plans with the ATO. They're potentially receiving things like director's penalty notices because they're falling in arrears, and the ATO isn't mucking around anymore, guys. We used to be able to use the ATO as a bank, and in many cases an interest-free bank, because we could negotiate away the general interest charges. But what you need to understand is as of the 1st of July, the interest charges are not only going to be no longer negotiable, but they're also going to be non-tax deductible, meaning that you have to pay that interest of 12% currently in after-tax dollars. That's going to require you to earn 16% to just meet the minimum repayment and cover the interest. So this is not an ideal situation, and this means that you must pivot your business or you are doomed to fail, okay? Now, we need to understand that there are basically 7 levers that you can influence when it comes to your financial model and your business. And most business owners are just focusing on a single lever, and that lever is more volume, more leads, more clients, more customers. They're basically just got this revolving door of trying to bring more clients and customers in order to grow and scale their business. And it's not to say that bringing in new clients is a bad thing. Sure, it's a great thing. However, if you do so without considering the other 6 levers, it is likely that you may not have a sustainable financial model to bring those clients in profitably. Why? Because you've got to acquire that customer. It's typically more expensive to deliver to a new customer than it is an existing customer, because obviously it's about getting them onboarded, getting them ramped up, the initial admin, getting into kind of systems and rhythms, all those kinds of things. A new customer is more difficult than an existing customer. So for this reason, you must ensure that you understand the other 6 levers and the impact on your business. So the second lever is price. So many business owners are shy around their pricing or are using guesstimate-based pricing. So it's like, okay, I think that my market will be prepared to pay this, instead of understanding what is your actual cost to serve, what is your value proposition and your positioning in the marketplace? And more importantly, how do you connect the price that you charge to the value that you provide and ensure that that pricing is actually sustainable? The interesting thing is that the vast majority of business owners are still pricing the way that they did when they were at a lower level of scale in their 6-figure ranges. And when they get to 7 and 8 figures, even though they've got more operational complexity, they've got more staff, they've got more costs, they've got more overheads, payroll tax, all of these other things, they haven't adjusted their pricing in consideration for those things. And of course, that means that you erode your margins, okay? So what we need to understand is we've got to work out what is your actual cost to serve, what is your cost of sales, what is your operating expense per customer and client, and how much margin do we want to make? Because good businesses, even in these times, should be able to profit between 20 and 30%. I don't care your industry. We've got clients who their industry average is less than a 10% margin, and we've got them doing 20, 25% profits, okay? So this is about how do we engineer a financial model for profit. So pricing is very, very important. Third one is understanding your variable cost of sales. So we've got to understand that for most businesses, we have a percentage of expenses for every dollar of revenue produced. And that's often linear, right? As we grow and scale our business, that cost of sales percentage typically will grow proportionate to that growth. But in some cases, it grows exponentially because of a couple of factors. One, the added complexity of a bigger business means that we are not project managing the expenses as much. So as a result, we have this cash flow creep. we are spending more on cost of sales, there's more wastage on the job, there's less accountability to the billable hours, and for that reason, we end up eroding margin. And we've got to understand that that variable cost of sales, because it has a direct and proportionate relationship, any improvement we make to that variable cost of sales is a direct transfer to the bottom line. Really, really important. Now, the fourth lever is your operating expenses. Do you have a system and a methodology in place to systematically review your operating expenses on ideally a monthly basis? So what we advocate we do, and we do this in our own business, is that we download all of the expenses, or our financial controller puts together all of the expenses. We have rules around our expenses, and then we review them each and every single month, where we keep it, we review it, or we put it on a watch list, or we cancel it. And every single month, we're validating that. When we started doing this, we freed up thousands of dollars a month in expenses. Whenever we do this with a client, there's always at least a couple $1,000s a month of expenses of things that just aren't really adding a lot of value. And as a result, they've forgotten about it and they're not using it, and that's costing them money. And then as you do this over time, it might only be a couple $100 a month that you're freeing up, but still that adds up over time. And ensuring that we're analyzing every single line item, and this includes your professional advisors, your accountant, financial advisors, business coaches, and making sure that you're getting a return on the investment for the expense is a really, really important factor. So these are our P&L levers, okay? And that all improves our P&L bottom line. Now, then we get to the balance sheet. We need to understand our accounts receivable days. So if you're a business that is invoicing on account, you need to understand how many days it takes you to get paid from your customers and clients. And ideally, we want to make sure that we can have a solution that allows us to get paid up front in advance, or at least we understand the timing of outflows of our expenses, so then we can charge proportionately, so we can ensure that we're at least covering our costs as they're going out. Because there is lots of big businesses that we've worked with that their P&L looks fantastic, but because their accounts receivable days are so long, they're actually, the faster they scale, the faster their bank account depletes. And it's because they don't understand their accounts receivable days. Then we've got work in progress or inventory days. So once again, if you're doing project-based work and you must get a job to a particular milestone in order to invoice for it, we need to understand that, right? Because ultimately this is going to allow us to work out, okay, well, how do we get to that stage faster, allowing us to invoice sooner, allowing us to get paid faster? And same thing with your inventory. If you are a product-based business, how long is your inventory sitting on your shelves before we turn that into cash flow on the P&L? And ultimately, how quickly we can revolve that inventory is going to be a very important metric to consider. And then lastly, our accounts payable days. So how long does it take you to pay your suppliers and pay your bills? And the important part here is about ensuring that our accounts receivable days is less than our accounts payable days, meaning that you get paid before you have to pay your suppliers. Because once again, if you're getting paid after you have to pay your suppliers, that means that the faster you grow, the more bills you incur, the faster your bank account starts going towards zero. And then we need to start finding ourselves in this position of having these debts. So we're going to understand that, yes, there are certain businesses out there more than ever that are in financial hardship because of their tax debts. But that is a symptom for your financial model. And if you don't fix that financial model, it doesn't matter what you do, you're going to find yourself back in the same position, wondering how you got there. And it's about taking control and understanding how you influence the 7 levers. We call this the 7 levers to endless profits. And for most of the businesses that we implement this, we can increase their profitability by, in many cases, 2 to 4 times what they're currently earning. So you deserve to earn that money. You don't deserve to be on the brunt, on the receiving end of having an insufficient financial model. So now is time for you to do something about it, because if you don't, you're going to be a whole lot of trouble. So let me know your thoughts. If you've got any comments or questions, drop them below, and we'll catch you later.